Wall Street just labeled the current silver supply situation as manageable right as the Silver Institute published a deficit report showing structural undersupply accelerating for the third consecutive year in a row. And they are pinning the whole story on temporary mine disruptions like that single explanation accounts for everything the data is showing. And that is exactly backwards. Because the silver shortage that is building right now is not temporary. It is not a disruption story. It is a structural story driven by the permanent intersection of declining byproduct output, accelerating industrial consumption, and a mining industry that is physically incapable of responding fast enough regardless of what the price does. The shortage nobody sees coming is already here. It is just not loud enough yet to get coverage on the channels that told you everything was manageable. I am recording this right now from New York, and I want you to comment what day and date you are watching from, because this is a story that compounds quietly before it becomes impossible to ignore, and I want the timeline documented. And real quick, if you value this kind of no-drama analysis that reads the structural data instead of the press releases, do me a favor. Subscribe and comment FinTalk OG so the algorithm knows you want more of this. Now here is the claim making the rounds. Silver demand is outpacing supply. There is a deficit. It has been running for multiple years. Prices should reflect this. And on the surface it sounds straightforward. Demand exceeds supply, prices go up. But when you slow it down piece by piece, you realize the market has been absorbing this deficit through above-ground stockpiles that were built up over decades. And those stockpiles are not infinite. They are finite. They are depleting. And at some point, the buffer is gone, and the price has to do the work that the buffer was doing. That is the moment the shortage becomes visible. That is the moment Wall Street stops calling it manageable. And that moment is closer than the headlines suggest. So I am going to break down three things. First, what the Silver Institute data actually shows about the supply-demand balance right now, and why the deficit numbers are more significant than the surface reading suggests. Second, why the mining industry cannot simply produce more silver to close the gap even if prices incentivize it. And third, what the depletion of above-ground stockpiles actually means for price dynamics when the buffer is gone. So let's start with what we can verify. The Silver Institute, which is the most comprehensive public source of silver supply and demand data, has documented a structural deficit in the silver market running across consecutive years. Total silver demand, including industrial, investment, jewelry, and silverware, has been exceeding total mine supply plus recycling supply for an extended period. The deficit gets filled by drawing down above-ground inventories. Those inventories, built up over decades when supply exceeded demand, are being depleted systematically. Now here is the number that matters most, and that almost nobody is talking about. The rate of depletion is accelerating. It is not a steady drain. It is speeding up. Because industrial demand is growing faster than the Silver Institute's previous models projected, driven primarily by solar panel expansion and EV production that has beaten earlier forecasts, while mine supply has not grown commensurately. That acceleration is the signal. When a deficit accelerates, the time to inventory exhaustion compresses. The runway gets shorter faster than a linear model would suggest. Now here is why mining cannot fix this quickly, and it is worth understanding the mechanics because this is where the real story lives. About 70% of silver production globally comes as a byproduct of mining other metals, primarily copper, zinc, and lead. That means when you need more silver, you cannot just build more silver mines and solve the problem. You have to wait for copper demand to justify more copper mines, which then produce silver as a byproduct. The economics of a byproduct are fundamentally different from a primary product. If silver prices double, that does not incentivize a copper miner to produce more copper. They produce copper based on copper economics. The silver just comes along for the ride. So the supply response mechanism that works for most commodities, higher prices attract more supply, is severely blunted in silver because the majority of production is not price responsive to silver specifically. It is price responsive to the primary metal being mined. That is a structural feature of the silver market that makes the shortage story more durable than a simple supply-demand model would imply. Think of it like this. Imagine a restaurant kitchen where the main dish is steak, and the garnish that comes with every plate is a small portion of a rare herb. The herb has no dedicated farm. It only grows as a companion plant to the beef cattle operation. If demand for the herb goes up but demand for beef stays flat, you cannot get more herb by planting more herb farms. You have to wait for the beef operation to expand, which it will only do when beef economics justify it. That is silver relative to copper and zinc. The garnish cannot outpace the main dish, regardless of how much the garnish is wanted. Here is a question for you. If 70% of silver supply is a byproduct that cannot be independently scaled, and the primary metals it comes from are in a down cycle, what happens to silver supply during a global manufacturing slowdown, even when silver demand from green energy stays strong? Drop that in the comments because the answer is counterintuitive, and I want to see how people think through it. Now let's talk about above-ground stockpiles, because this is the buffer that has been absorbing the deficit and the buffer that is running out. Silver stockpiles held in exchange warehouses, in eve vaults, in government reserves, and in private hands accumulated during the decades when silver supply exceeded demand. Think of them like a reservoir. When rainfall exceeds what the land absorbs, the reservoir fills. When demand exceeds rainfall, you drain the reservoir to meet demand. Right now, the reservoir is being drained. And the critical question is, how full was the reservoir when the draining started, and how fast is it draining now? The honest answer is that the data is incomplete because private stockpiles are not reported. But exchange warehouse data, which is the most visible portion, shows a trend that is directionally clear. The registered silver available for delivery has been declining, not every week, not in a straight line, but the trend over months and quarters is down. And when you combine that visible decline with the known deficit rate from Silver Institute data, the trajectory points toward a stockpile level that starts to matter for price discovery within a time frame measured in years, not decades. Now here is the skeptical alternative. Could new primary silver mines come online fast enough to change this picture? Could technological improvements in recycling recover enough silver from industrial applications to refill the stockpile? Yes and yes are both theoretically possible. Here is why they fail as near-term solutions. New mine development takes 7 to 10 years from discovery to production. The permitting process alone in most jurisdictions takes years. If you started permitting a primary silver mine right now as I am recording this, it would not produce silver until the early part of the next decade. That is not a near-term supply solution. That is a long-term investment that will eventually matter but does not change the deficit that is running today. And recycling technology for industrial silver is improving, but not at a pace that can offset the volumes being consumed by solar, EVs, and electronics. The application silver is being used and consume it in quantities so small and so dispersed across individual components that recovering it commercially is technically and economically challenging. The sandpaper analogy applies here perfectly. Think of silver demand like sandpaper. It gets used up in tiny bits across 1 million applications. You do not recycle sandpaper. You consume it and order more. and I am going to say something that might annoy both sides. The shortage is real, and it is building, and it matters for long-term prices. It is also not going to resolve in a single violent price spike that fixes everything overnight. Markets are slow to price in structural stories that build quietly. The shortage will get worse for a period before the price fully reflects it. And the people who position ahead of the recognition event, when the narrative shifts from manageable to critical, those people capture the move. The people who wait for the headline to confirm what the data already showed, they buy much higher. Same shortage, different timing, very different returns. Now let's map two plausible paths without pretending we can predict the exact candle. Path 1. The shortage continues to build slowly. Exchange inventories keep declining. The Silver Institute keeps reporting deficits. Industrial buyers start securing longer-term supply contracts because they are worried about availability. Those contracts remove supply from spot markets, tightening conditions further. Premiums on physical silver start rising. The paper price begins to reflect the physical tightness over several quarters. Silver grinds higher, not explosive, structural. That is the base case, and it is already in motion. Path 2. A supply shock accelerates the timeline. A major mining region has a disruption. A key copper producer has a strike or a regulatory shutdown, reducing the silver byproduct flow. At the same moment, a major solar installation program in a large economy triggers an urgent procurement cycle for silver. Industrial buyers competing with investment buyers for a suddenly tighter physical supply pushes premiums to levels that cannot be ignored. The paper market reprices fast. What was going to take 3 years happens in 6 months. That is also plausible. I am not predicting it. I am saying the preconditions are in place for it. Here is what to watch. First, watch the Silver Institute's annual supply and demand data. The deficit number year over year tells you how fast the stockpile is being consumed. If the deficit is growing, the timeline is compressing. Second, watch COMEX registered silver inventory weekly. That is your most visible real-time signal. A persistent downward trend confirms physical absorption is outpacing replenishment. Third, watch silver premiums at major dealers. When premiums start rising above 5% and staying there, that is physical stress leaking into the retail market. Fourth, watch byproduct metal performance. If copper and zinc mining output weakens globally, silver byproduct supply weakens with it. That is a supply constraint that arrives independent of silver-specific demand. So what do you actually do with this information? Here is a simple action plan. No drama. Step 1. If you do not own physical silver, this is the argument for starting a position, not because of price targets or forecasts, because the structural supply-demand balance is deteriorating and the market has not fully priced it in. Step 2. Size it for a multi-year thesis. The shortage does not resolve in months. It plays out over years. Sizing for a long-duration thesis means not using leverage and not expecting quick validation. Step 3. Consider physical over paper for the portion of your silver exposure that is specifically about the shortage thesis. Because if the shortage becomes acute, the divergence between physical and paper silver can be significant, and you want to own the thing that is actually scarce. Step 4. Write down the metrics you are watching and check them on a schedule, not daily, monthly. Quarterly. The shortage story does not need daily monitoring. It needs patient tracking of the structural indicators. Now here are my questions for you. Do you think the mainstream financial media picks up the silver shortage story before or after the price moves significantly to reflect it? And if you had to guess how many more years the above-ground stockpile can absorb the current deficit rate, what is your estimate? Drop your answer below and remember to include what day and date you are watching from. Subscribe and comment FinTalk OG so I know you want updates every time Silver Institute data or exchange inventory data gives us a clearer picture of the timeline. And share this with someone who thinks silver supply and demand is too boring to pay attention to and has no idea what the data is showing right now. All right, stay sharp, and I will talk to you soon. And just so we are crystal clear, this is educational content. It is my take based on publicly discussed information and my own reasoning, and it is not personal financial advice. I am not your advisor. I do not know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation. And if you need personal advice, get it from a qualified professional who knows your situation.